We're here to take complex information and, well, make it clear so you walk away feeling informed, not buried in details.
Exactly. And today we're tackling stock investing. Specifically, we're digging into Pat Dorsey's The 5 Rules for Successful Stock Investing. It's a great blueprint if you've ever felt, a bit lost in the market.
Yeah, investing can definitely feel like trying to drink from a fire hose sometimes. But Dorsey really focuses on the core behaviors, the discipline needed.
That's the key word, discipline. Dorsey's whole philosophy hinges on having a steady strategy. You don't build real wealth by jumping around. You need to master wise investing first.
Okay, so there are 5 main rules. Let's jump straight into one that trips a lot of people up. Rule 3, the margin of safety. It feels like the ultimate protection against, well, getting ahead of ourselves.
It really is. Rule 3, insist on a margin of safety. It's not just about finding a fantastic company. You absolutely have to buy it at the right price.
Right. But isn't that counterintuitive? If a company like, say, Coca-Cola is obviously great, why wouldn't you just pay whatever it takes?
Because, and this is crucial, even the best businesses can give you disappointing returns if you pay way too much. Dorsey points to Coke back in the early 90s. Amazing business, no doubt.
Yeah.
But investors who paid those really high prices back then didn't see great returns for years, even decades later. The price was just too high compared to what it could realistically earn in the future.
So the margin of safety is like a buffer zone, protection against what, being too optimistic or maybe unexpected problems?
Both, really.
Yeah.
It cushions you against your own biases and against things you just can't predict. And speaking of biases, Dorsey lists these 7 common mistakes. The anti-rules, if you will.
The traps. Okay, I see some are about psychology, like greed and fear.
Exactly. First, there's chasing those huge returns with super risky stocks. And tied to that is believing this time is different. Thinking the old valuation rules just don't apply anymore.
Yeah, we saw that before the dot-com crash, didn't we?
We certainly did. Then there are the emotional traps, like falling in love with a cool product instead of the actual business fundamentals. You invest with your head, not your heart.
Or panicking when the market drops.
Right, selling low out of fear. Experienced investors actually see those downturns as opportunities, like a temporary sale on good companies.
Okay, so those are the psychological pitfalls. What about the accounting traps?
Well, there's trying to time the market perfectly, almost impossible to do consistently. Then ignoring valuation altogether, the exact opposite of Rule 3.
And the last one?
Blindly trusting the earnings numbers reported by a company. This brings us straight back to rule number 1. Always do your homework.
Why? Can't you just look at the profit?
Because earnings can be, let's say, managed. Dorsey is adamant that the real truth, the company's actual financial health, isn't just in the profit number. It's in the cash flow, where the actual money is moving.
Okay, cash flow. That means we need to understand the language, the financial statements. You don't need to be an accountant, but you need the basics.
Absolutely. 3 key reports. First, the balance sheet. Think of it like a photo, a snapshot at one specific moment. What the company owns, its assets, versus what it owes, its liabilities.
Assets minus liabilities gives you shareholder equity.
Exactly. Then number 2, the income statement. This covers a period of time like a quarter or a year. Shows revenue, subtracts expenses, and gives you the net profit or loss.
And the third, the most important one you said?
The cash flow statement. This tracks the actual cash coming in and going out. This is vital because, well, reported profit doesn't always mean cash in the bank.
Right, let's use that example from the source material, the Colgate one. Selling goods to Joe's corner store.
Yeah, great example. Colgate sells, say, $1,000 toothpaste to Joe's store. They give Joe 60 days to pay.
Okay.
On Colgate's income statement, that $1,000 shows up as revenue immediately. Looks good, right? Profit. But the cash flow statement shows $0 coming in until Joe actually pays, maybe 60 days later. If too many customers take too long to pay, Colgate could be showing profits but actually struggling to pay its own bills because the cash isn't there.
Wow, okay. That's a huge difference. Real strength is having the cash. So once you grasp cash flow, you can tackle Rule 2, finding an economic moat.
Precisely. The moat is that unique competitive advantage, something that protects the company's profits from competitors. Think of a castle with a really wide moat around it. Dorsey gives us 4 steps to find one.
Step 1.
Assess profitability. Is the company significantly more profitable than its peers? High returns often mean there's something protecting it. a moat.
Okay, then step 2, figure out what that something is.
Exactly. Identify the source. Is it a super strong brand people won't switch from? Is it high switching costs? Like, it's a pain for customers to change providers. Or maybe they just have a massive cost advantage others can't match.
And third,
Determine its durability. This is crucial. Will that advantage still be there in 5 years? 10 years? A short-term tech lead isn't a real moat.
it's just a head start.
Right. And finally, step 4. Look at the whole industry. Is the industry itself healthy or shrinking? Even a castle in a crumbling kingdom isn't a great bet. Intense competition wears down moats fast.
Makes sense. So we've got the numbers, the moat, now the people analyzing management quality.
Yes, the human element. You want managers who think and act like owners, who put shareholder interests first. We look at 3 main things here.
Starting with compensation.
Check the proxy statement. Is their pay tied to sensible long-term performance? Or does it incentivize crazy risks? Big red flag. Huge salaries compared to peers, especially if the company's performance is just average.
Okay, compensation. What's area 2?
Character. You're looking for signs they might be using the company for personal gain. That example you mentioned earlier.
Oh, the CEO hiring their spouse's interior design firm for a fortune. Does that really happen?
Sadly, yes. Things like overly generous contracts for family members, especially if they lack qualifications. It signals a basic lack of respect for the shareholders' money.
Yikes. Okay, so compensation, character, and the third area.
Competence in running the business, especially regarding cash flow. Good managers face problems head-on. They don't hide them. Lucent Technologies in the late 90s is a classic case study here.
What happened there?
Well, their reported income was going up, looked great, around $3.5 billion. But underneath, big trouble was brewing. Customers were taking much longer to pay their bills.
Ah, like the Joe's Corner Store problem, but bigger.
Much bigger. And they were piling up huge amounts of inventory they couldn't sell. So profits looked okay on the income statement, but their actual cash flow was drying up fast. Management didn't acknowledge the problem publicly or seem to tackle it effectively.
And that led to serious problems down the line, so you track their competence by watching the actual cash.
You have to. Once you've done all that qualitative work, the rules, the management check, which also informs Rule 5, knowing when to sell, you circle back to Rule 3, the margin of safety.
Yeah.
And that requires calculating intrinsic value.
Right. We've assessed the quality, the moat, the management. Now we need to figure out what it's actually worth. Intrinsic value, the true underlying value, not just today's stock price.
And the definition is key, coming from economist Irving Fisher. Intrinsic value is the present value of its future free cash flows.
Okay, present value, future free cash flows. That connects everything. The quality of management affects the moat's durability.
And the moat's durability dictates how reliably you project those cash flows into the future.
Exactly.
And free cash flow, FCF, that's the cash left over after everything's paid and reinvested, the actual profit available to owners.
That's it. And we have to discount those future cash flows back to today's value because, well, $1 you might get in 5 years isn't worth the same as $1 in your hand right now. There's risk, there's delay, time value of money. We can see how this all fits together with the AMD example from the book, looking back at the 90s and early 2000s.
Yeah, applying this framework to AMD back then showed some serious issues. Their free cash flow was often negative. They were sinking money into investments that weren't clearly paying off.
And debt.
A huge debt, almost $1.9 billion by 2002. Add to that, the management flags the CEO getting $1 million salary, plus high pay for other execs, even while the company struggled financially and wasn't generating consistent free cash flow.
So negative FCF, tons of debt, questionable management pay. The risks just seemed way too high.
Absolutely. It failed the margin of safety test. It failed the management quality test. Based on Dorsey's rules, it just wasn't a safe long-term bet at that point in time.
Okay, so we have the rules, the analysis framework. Let's look quickly at how Rule 2, the economic moat, plays out in different sectors, like software.
Software can have really strong moats. Think about it. It costs a lot to create the initial product, like Windows or big database system.
Right.
But once it's made, the cost to produce another copy is practically zero, especially with the internet for distribution. So companies like Microsoft or Oracle could scale incredibly fast, make enormous profits. The moat often comes from high switching costs or network effects. Everyone uses it because everyone else uses it.
Okay, contrast that with something like airlines, which Dorsey puts under business services, the hard asset kind.
Yeah, airlines are tough. They're incredibly capital intensive, always needing new planes, dealing with fuel costs, gate fees. Fixed costs are massive, variable costs swing wildly.
So hard to build a lasting advantage.
Almost impossible. It's brutally competitive. If one airline cuts fares, pretty much everyone else has to follow suit or lose customers. Historically, it's been a really poor performing sector for investors. You have to be extremely cautious.
So software moats from IP and network effects, airline moats constantly eroded by costs and competition. What about healthcare?
Healthcare often does well. People need it regardless of the economy. Plus, you have strong patent protection for drugs, which is a powerful moat. But
There's always a but.
yeah. Pharmaceutical R&D is incredibly expensive and super uncertain. A promising drug can fail late-stage trials, and biotech especially requires deep, specialized scientific knowledge to really understand the risks. If you can't assess that pipeline risk, Dorsey would say you haven't done your homework. Stay away.
Makes sense. Stick to what you can understand. Lastly, consumer goods, like food, drinks, soap.
Consumer staples often deliver excellent long-term returns, even if growth isn't spectacular. Why? Because we buy this stuff, food, drinks, personal care items, pretty much no matter what the economy is doing.
They're essentials.
Exactly. Strong brands build loyalty. Think about your favorite soda or toothpaste. You probably don't switch brands often. That creates a predictable, durable moat, provided the companies manage their cash flow well and advertise smartly.
So wrapping this all up, following these rules, doing the analysis, it's not about finding some magic bullet stock, is it?
Not at all. The whole point, the ultimate goal, is risk reduction, massive risk reduction.
If you don't do the homework, the 5 rules, the statements, the management check, then investing really does become just gambling.
Precisely. The path to building wealth consistently is through clarity, confidence, and, that word again, discipline.
Okay, so for our final thought, you mentioned intrinsic value is all about projecting future free cash flows based on the durability of that economic moat.
Yes, the whole valuation rests on how long you believe that competitive advantage will last.
5 years, 10 years, 20.
So here's the challenge, the provocative thought. If value depends on predicting the future, how do you really quantify something like brand loyalty or a network effect 10 years out? Especially in sectors like tech where things change so fast.
That's the million-dollar question, isn't it? Understanding the numbers is one thing. Putting a reliable number on the longevity of a company's competitive position, especially the more intangible parts, well, that's the constant challenge. That's where the art meets the science in investing.